The most expensive sentence in speculation is, "It's gone down enough." It is the siren song that has led more men to the rocks of ruin than any other. It is an appeal to hope over fact, a prayer whispered in the face of an oncoming storm. You believe you are being clever, catching a bargain that others are foolishly discarding. In reality, you are stepping in front of a locomotive armed with nothing but a theory. This is not a new mistake. It is a fundamental flaw in human nature, one I documented in my life's work. Reminiscences of a stock operator. If you wish to understand the timeless battle against these impulses, the link is in the description of this video. The lessons are as vital today as they were a century ago because the enemy you fight is not the market. It is yourself. The belief that you can intelligently buy the dip is the single greatest destroyer of trading accounts, second only to the refusal to cut a loss. In fact, they are two heads of the same hydra, born from the same fatal impulse, the inability to accept that you are wrong. You see a stock, once a market leader, that has fallen from $100 to $80. Your mind immediately tells you it is 20% cheaper. You see a discount. I see a warning. I see a change in character. The first question a professional asks is not, "Is it cheap?" but "Why has the price fallen?" The amateur does not care about the why. He is mesmerized by the what. He sees the lower number on the screen, the modern equivalent of the ticker tape that used to stream through my offices, and believes he has found an edge. He has found nothing but the edge of a cliff. A stock does not fall 20% without a reason. Perhaps the reason is not yet known to the public, but it is known to someone. The tape tells the story long before the newspapers do. That drop in price is the result of selling, and not just any selling. It is persistent, determined selling from those who know more than you do. You, the dip buyer, are providing them with the very liquidity they need to unload their shares before the real trouble begins. You are not buying a bargain. You are absorbing the supply of informed sellers. You are playing the part of the fool at their poker table. Let me tell you about a time I played the fool. It was in cotton. I had made a fortune being bullish on cotton, riding the great trend upward. I had my theories, my charts, my fundamental reasons. I was convinced cotton was going higher. The market, however, decided otherwise. It began to fall. My first purchase was now at a loss. Did I sell? No. I was Jesse Livermore. I was right about the market. The market was temporarily wrong. So when the price dipped, I bought more. I reasoned that if I liked it at the higher price, I must love it at the lower one. It dipped again. I bought again. I was no longer trading. I was arguing. Each purchase was not a speculation on the future, but a defense of my past decisions. I was fighting the tape, and the tape is the general of an army that never loses. It is the force of the entire market, and I was just one man. My capital was draining away, my judgment clouded by stubborn pride. I was buying dip after dip, averaging my cost down, but all I was truly doing was increasing my commitment to a mistake. I was digging my own financial grave, one contract at a time. The line of least resistance was clearly downward, but I refused to see it. I saw only what I wanted to see. My original thesis. This is the core of the problem. Most traders who buy the dip are not reacting to a technical signal of strength. They are reacting to the emotional pain of having missed the initial run-up. They see the pullback not as a warning, but as a second chance. It is a trade born of regret, and no profitable enterprise was ever built on a foundation of regret. You are not analyzing the market. You are medicating your own fear of missing out. You are confusing a potential normal reaction with a definite change of trend. A normal reaction is a healthy thing. In a powerful bull market, a stock might advance 10 points and pull back 3. This is the market breathing. But how do you distinguish this from the beginning of a 20-point collapse? The amateur cannot. He buys every 3-point drop with the same blind hope. The professional, however, waits for clues. A normal, healthy pullback occurs on lighter volume. It shows a lack of aggressive selling pressure. The sellers are few, merely taking short-term profits. The stock finds support at a logical level, a previous peak perhaps, and most importantly, it does not stay down for long. It quickly firms up and resumes its advance. The dip buyer does not wait for any of this. He buys into the heart of the decline, while the selling is still heavy, while the volume is high, while the stock is slicing through old support levels as if they were butter. He is not a speculator. He is a gambler betting on a number at a roulette wheel. He is betting on a bottom, and attempting to pick bottoms is a pastime for fools. The big money is not made by buying at the exact bottom or selling at the exact top. It is made by capturing the great middle of a move. You do not need to be the first one in or the last one out. You need only be on the right side of the major trend. Buying the dip is a direct violation of this principle. It is an act of defiance against the trend. Think of the market as a great river. The main current is the primary trend. When the river is flowing north, your task is to get in your boat and row north with it. You will travel far and fast with little effort. Buying a dip in a falling market is the equivalent of turning your boat around and trying to row south against that powerful current. It is exhausting, pointless, and ultimately you will be overwhelmed and swept away. Why would you engage in such a struggle? Why not simply wait for the river to change direction? Wait for the selling to exhaust itself. Wait for the stock to stop going down. This is the first and most crucial step. A stock that is falling is, by definition, weak. Do not buy weakness. Wait for it to stop being weak. After it stops falling, what is the next step? Does it immediately become a buy? No. It must prove itself. It must show you that the internal pressure has shifted from selling to buying. This often takes the form of a base, a period of sideways consolidation where the stock trades in a narrow range. In the old days, we called this accumulation. It was the quiet work of large informed interests buying up shares from weak hands without driving the price up too much. On your modern charts, it looks like a flat line after a steep drop. This is the market coiling a spring. Your job is not to buy during this period of uncertainty. Your job is to watch it, to place it on your list, and to wait with the patience of a sniper. You are waiting for the breakout. You're waiting for the moment the stock proves, with a surge in price and a surge in volume, that the line of least resistance has finally turned upward. That is your signal. That is the moment of least risk. You are not guessing the bottom. You are reacting to a confirmed change in direction. You are buying strength, not weakness. Let us examine the mathematics of this folly. You buy a stock at $100. It falls to 90, a 10% loss. If you follow my rules, you sell. Your loss is small, your capital is preserved, and you are free to seek the next opportunity. The dip buyer, however, sees a bargain. He buys more at 90. Now his average price is 95. The stock falls to 80. His 10% loss has now morphed into a nearly 16% loss on a position twice the size. He has doubled his risk on a failing idea. Perhaps he buys even more at 80, desperate to lower his average cost. His position becomes dangerously large, his judgment hopelessly compromised. The stock is now at 70. That initial, manageable 10% loss has become a catastrophic 30% collapse that threatens his entire account. A stock that falls 50% requires a 100% gain to get back to even. The dip buyer, by averaging down, ensures he is fully invested for that entire 50% drop, making the climb back to profitability a near impossibility. He has violated the cardinal rule of speculation: never average a loss. You are not a long-term investor, dollar cost averaging into a broad market index over decades. You are a speculator. Your capital is your ammunition, and you cannot afford to waste it on a losing battle. This impulse is rooted in a fundamental misunderstanding of value. In the world of tangible goods, a lower price for the same item is always better value. If a fine suit costs $500 on Monday and $400 on Tuesday, it is a bargain on Tuesday. Stocks are not suits. The value of a stock is not its price today, but its potential price tomorrow. A stock at $100 that is on its way to $200 is cheap. A stock at $20 that is on its way to $5 is expensive. The price itself is meaningless without the context of the trend. The amateur sees the price tag. The professional sees the direction of travel. My greatest successes came from buying stocks that were already making new high prices. This seems counterintuitive to the bargain-hunting mind. Why buy something that is already expensive? Because its strength is a fact. A stock making a new high is in a technical position of strength. There is no overhead supply of disgruntled buyers waiting to sell and get their money back. It is in open country, with the line of least resistance pointed firmly upward. Buying a falling stock is the opposite. You are buying into a wall of sellers. Every tick higher brings out more people who are desperate to escape their losing position. You are buying a problem. I made my money buying solutions. The psychological trap is even more insidious than the mathematical one. When you buy the first dip, you anchor your ego to the trade. Every subsequent dip you buy is a doubling down on your own infallibility. You can no longer analyze the stock objectively. To sell it for a loss would be to admit a chain of compounded errors. The human ego finds this almost impossible. So you hold on, and you hope. Hope is the most dangerous word in a speculator's vocabulary. It is the anesthetic that dulls the pain of a growing loss while the disease spreads. You stop looking at the chart and start looking for news, for rumors, for any external justification for your failing position. You read bullish articles about the company's long-term prospects, ignoring the present reality that the stock is collapsing. The market is a battlefield, not a debating society. Your opinion, my opinion, the opinion of the smartest analyst on Wall Street, they are all worthless in the face of the tape. The tape is the ultimate truth. And when the tape says a stock is going down, it is going down. To argue with it is madness. So what is the unbreakable rule you must carve into your mind? It is this: you must never, under any circumstance, add to a losing position. Not ever. A trade must show you a profit from the very beginning. Your first entry is a probe, a test of the market. If it goes against you, it is a signal that your timing is wrong. The proper response is not to increase your bet, but to withdraw from the table. Cut the loss immediately and without emotion. It is simply the cost of doing business, a small tuition paid to the school of the market. If the trade moves in your favor, that is the market validating your judgment. Only then, on a show of strength, do you have permission to add to your position. This is the art of pyramiding, building upon success, not failure. The dip buyer does the exact opposite. He penalizes his winners by taking them off the table for a small profit, and rewards his losers by giving them more capital. It is a perfect formula for ruin. Do not try to be a hero. Do not try to catch the falling knife. Your duty is not to find the absolute bottom. Your duty is to protect your capital and wait for the easy money. The easy money comes from riding an established trend, not from guessing its inception. Let the market show its hand. Let the stock prove its strength. Let the line of least resistance become so obvious that a child could see it. Then, and only then, do you act. To buy a falling stock is to pay for the privilege of being wrong. It is to finance your own destruction. Resist the temptation. The market is not running away. Another opportunity, a better and clearer one, is always coming. The patient speculator, the one who waits for fact to align with his theory, is the one who will be there with his capital intact to seize it. The dip buyer will not. He will be on the sidelines, his account empty, nursing the wounds of a battle he never should have fought.